Welcome to Iron Financial. This is the place where we do the heavy lifting, so you can forge a stronger portfolio and cut right through all the market weakness. Now, today, we are putting a financial giant squarely under the microscope, ORIX Corporation. This Japanese conglomerate just dropped an earnings report that, well, it sent a shockwave through the markets. They posted record-breaking profits, and of course, the headlines are all screaming success. But our job, as always, is to go beyond those headlines. We're going to tear down the numbers, and we're going to see if this company is really building a financial fortress, or if it's just, putting up a fancy facade. So let's get into it.
So look, the numbers they've reported for the first 9 months of the fiscal year are, on the surface, incredibly impressive. I mean, we are talking about massive year-over-year gains that would make any investor's ears perk up. But here at Iron Financial, we just don't take press releases at face value. We put them to the test. We're going to stress test these figures, we're going to inspect every single line item, and we're going to determine if the structure, the very bone supporting these profits, is made of solid steel or something a lot weaker. We need to find out if this performance is a sign of true underlying strength that can actually weather any storm the market throws at it.
Okay, hold on. Let's just cut right to it. Everybody sees the big, flashy profit number. The market gets all euphoric. But, I've seen this playbook 1,000 times before. A company can juice its numbers for a quarter, maybe two, but what is really holding it all up? Are we looking at real, sustainable, operational excellence here, or is this just some clever financial engineering? Is the foundation solid, or are we just seeing a little bit of superficial strength? Something designed to look good for a single earnings call. That is the core question we have to answer today, because portfolios, real portfolios, are built on foundations, not on facades.
Exactly. And that's precisely why we're calling this the ORIX growth anomaly. Look, in a market that's giving us all sorts of mixed signals, seeing a company of this size, this complexity, post these kinds of numbers, well, that isn't just business as usual. It's an anomaly. It is a massive signal flare that demands we investigate. We have to understand what's driving this. Because listen, if it's real, it represents a significant opportunity. But if it's not, it is a trap just waiting for unwary investors. So, let's start the inspection.
Right. So before we get into the really complex machinery of their balance sheet or the cash flow statements, we have to start where every single analysis begins, the income statement, the P&L, the profit and loss. Think of it like the primary blueprint that tells us the overall health of the company's operations. It tells us how much money is coming in the front door and, maybe more importantly, how much of that is actually left after all the bills are paid. So let's lay out the basic framework and see what we're really working with here.
Okay, let's get the core numbers up on the board. As you can see right here in this table, the top line, total revenues, is up a very solid 12%. That's healthy. I mean, nobody's going to complain about that. But that's not the story. I want you to direct your eyes to the bottom line, net income. It rocketed from about 271 billion yen to nearly 390 billion. That's a staggering 43.4% surge. Now, those are the headline numbers causing all the excitement. And that huge gap between top-line growth and bottom-line growth, well, that's what we need to investigate. Okay, fine. The numbers are bigger. I see it. But bigger doesn't always mean better. A 12% revenue bump that somehow leads to a 43% profit explosion, that smells interesting. It makes me ask a lot of questions. Where is that growth really coming from? Is it from their core, repeatable, day-in, day-out business operations, or did they just get lucky and sell off a major asset? Is this high-quality, durable growth we're looking at, or is it just a one-time sugar high that's going to fade by the next quarter? Top-line numbers can be incredibly misleading. We need to dig into the composition of that growth before we even think about celebrating.
And that is the right question to ask, and it's exactly why we're here. So let's start forging. We are going to hammer on this top line, and we're going to see if it holds its shape under pressure. We need to confirm that this first pillar, the revenue, is solid steel before we can even begin to trust the rest of the structure it's supposed to be supporting. Now, what's really interesting when you look at this slide is the sheer scale of it all. Adding 250 billion yen in revenue, that isn't a small move, especially for a company of this size. To put that into perspective for you, many entire industries don't see that kind of nominal growth in a full year. This isn't some little startup's growth spurt coming from a low base. This is a titan, a giant, showing surprising agility and serious market penetration. So the first pillar of their performance, the revenue stream, it appears incredibly robust.
Let's just put a fine point on it. 11.8%. For a mature, multi-trillion yen company, achieving double-digit revenue growth is a sign of serious momentum. That's especially true when you see so many of its competitors struggling just to post mid-single-digit gains. This tells us that their various business segments, everything from corporate finance to real estate and investment, are not just stable. No, they're actively going out and taking market share. This isn't anemic flatline growth. This is the kind of powerful forward thrust that can drive significant bottom-line results. But of course, as we know, revenue is only half the story.
And it's the less important half, if you ask me. You know the old saying on the street, revenue is vanity, profit is sanity, but cash is king. Honestly, I'm not impressed by how much money they can bring in the front door. I'm impressed by how much they can keep. Anybody can grow revenue by cutting prices to the bone or by taking on incredibly risky business. That's the easy part. The hard part, the part that proves a company's real strength and its discipline, is turning that revenue into cold, hard profit. So enough with the vanity metrics. Show me the sanity. Show me where the real strength is in this report.
Challenge accepted. Because you've just hit on the most compelling part of this entire story. The real story here isn't just about revenue growth. It's about ORIX's incredible ability to convert that growth into powerful, accelerating profits. This is where we see if the company's operational machinery is efficient or if it's wasteful. And based on these numbers, well, it looks like the profit engine isn't just running, it is absolutely roaring.
All right, so here it is, the full consolidated P&L. And I get it, it's dense. It's a wall of numbers. But the truth is buried right in there. We're going to cut right through all of these different line items to the one number that really tells the entire story.
Exactly. This is what turns most investors off. They see a table like this and their eyes just glaze over. Don't walk me through the whole thing, line by line. Cut through the noise for us. We're here to forge a strong portfolio, and that means finding clarity in the chaos. Pinpoint the single most important metric on this entire sheet. What is the one number that you believe proves the bull case for ORIX? The one number that tells the real story of its strength?
This one, right here, 43.4%. That is the year-over-year growth in net income attributable to ORIX Corporation shareholders. Now let me be clear, this is the bottom line of the bottom line. After every single expense, every tax, every interest payment is accounted for, the profit left over for the people who actually own the company grew by a staggering 43.4%. This isn't just good, it's explosive. This is that profit engine roaring to life. This single number demonstrates incredible operational leverage. It shows that for every new dollar of revenue that comes in, a much larger portion is falling straight to the bottom line. This, right here, is the core of the entire investment thesis.
And this slide right here brilliantly illustrates how that corporate profit translates directly into shareholder value. Basic earnings per share, or EPS, it jumped from 237 yen all the way to 347 yen. That's a 46% increase. So why does this matter so much? Because this is how you, as an investor, actually feel the company's success. It's the portion of the company's profit that's allocated to each and every outstanding share of stock. A 46% increase in EPS is a massive boost to the value proposition of owning a piece of this company. It's the tangible result of that roaring profit engine we were just talking about.
And just to prove this isn't some kind of fluke caused by a tax loophole or some clever accounting trick, just look at the strength across the entire profitability spectrum. Operating income. That's the profit from the core business operations. It's up a very healthy 26%. Then income before taxes is up an even more impressive 48%. And finally, net income is up that 43% we highlighted. When you see strong double-digit growth at every single level of the profit statement, from the operations all the way down to the final net number, it tells you the strength is systemic. It's a sign of a finely tuned machine firing on all cylinders.
All right, I'll concede it. The profit numbers are impressive. The engine is clearly running hot. But, you know, a powerful engine in a car that has a cracked frame is just a recipe for disaster. This rapid growth, this profitability, it's great. But what is supporting it all? How much risk is this company taking on to generate these kinds of returns? You can't just look at the P&L in a vacuum. So now it's time we shift our focus from performance to stability. It's time to check the foundation. Let's get into the balance sheet.
Okay, now this is what gives me pause. We see assets of 18.1 trillion yen, but liabilities of 13.4 trillion yen. Let me break that down. That means for every dollar they have in assets, they're carrying about 74 cents in debt and other obligations. You know, that ratio feels high. My question is this explosive profit growth just being fueled by cheap debt? Are they taking on mountains of leverage to juice these returns? Because that introduces a significant amount of risk, especially if interest rates rise or the economy takes a turn. We need to be absolutely sure about the structural integrity here before we go and declare this thing a fortress.
And that's the critical question. But you're looking at the raw numbers in isolation. For a financial services firm, which is essentially in the business of borrowing and then lending money, looking at just the raw debt figure can be really misleading. Their entire business model is managing a massive balance sheet. The key metric, the true measure of its foundation, is the shareholders' equity ratio. And ORIX's is sitting at 25.3%. This number tells you how much of the company's assets are financed by the owner's capital versus how much is financed by debt. For this industry, anything that starts to dip below 20% gets worrisome. Being over 25% represents a very solid, conservative, load-bearing foundation. It shows they have a substantial capital cushion that's capable of absorbing shocks and comfortably supporting their debt load. This isn't a company that's built on some precarious mountain of leverage. This is a well-capitalized institution.
And here is the payoff. It's that strong foundation, that 25.3% equity ratio, that gives the company the stability and the confidence to directly reward the people who own it, the shareholders. A weaker, over-leveraged company has to hoard every single penny of cash it makes just to service its debt and keep its creditors happy. But a company with a solid foundation like ORIX can actually afford to be generous. Let's see how this strong foundation translates directly into cold, hard cash in shareholders' pockets.
This is the proof. This is where the rubber really meets the road for investors. ORIX has already paid an interim dividend of over 62 yen per share. On top of that, they're forecasting a year-end dividend of nearly 58 yen. You add that all up, and it brings the total forecasted annual dividend to over 120 yen per share. Now, this isn't just some promise of future value. It's tangible cash being returned to shareholders right now. It is a direct and powerful signal from management that they are incredibly confident in the company's financial strength and its ongoing ability to generate cash.
So, we've inspected the blueprints. We've kicked the tires on the top-line revenue. We've stress-tested that roaring profit engine. And we've drilled down into the core of the balance sheet foundation. We've seen how all that strength translates into direct returns for shareholders. So now, it's time. It's time to put all the pieces together and deliver the final iron financial verdict on ORIX. Okay, so the crucial point is this. The bull case is clear, and it isn't just a facade. It is a fortress built of hard data. A record 43% surge in net income isn't some random anomaly. It is the direct result of a powerful engine translating a solid 12% revenue growth into explosive profit. And that entire structure is supported by a 25.3% equity ratio, a foundation so strong it can generously return capital to shareholders while still forecasting a full-year net income of a whopping 440 billion yen. Every single metric we've looked at points in the same direction: strength, growth, and stability.
Okay, you've laid out the evidence. The numbers are compelling, I'll give you that. So let's end with the ultimate question for our viewers and for their portfolios. We've done the heavy lifting. We have inspected the framework from top to bottom. We've answered the tough questions. So give us the final verdict. Based on this exhaustive analysis, is ORIX a financial fortress built to last, or is it a house of cards just waiting for the next market wind to come along and blow it over? Make the call.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.